If you live in the US, Canada, the UK, Germany, Australia, or South Africa, the number $315 trillion in global debt probably feels so big it might as well be science fiction. You hear it in a headline, maybe shake your head, and then go back to your own problems: rent, mortgage payments, grocery bills, school fees, retirement savings that never seem to keep up. But here's the uncomfortable truth. That giant, abstract number is the backdrop to almost everything that feels off in the modern economy, from housing prices and wage stagnation to market bubbles and political tension. It is not just a statistic, it is a symptom of where we are in a much older story. In this video, you are going to see how today's debt mountain fits into roughly 400 years of financial history, and what that history suggests usually happens when numbers like these show up. Let's begin with what that $315 trillion actually means. When analysts talk about global debt at that scale, they are adding up three main piles: government debt, corporate or business debt, and household debt across almost every country on Earth. That total now stands at more than 3 times global GDP, meaning the world owes far more on paper than it produces in a single year. In practical terms, it means that every major player in the system, states, companies, families, has promised future income to someone else, often years or decades in advance. In the United States, federal debt has climbed to levels that earlier generations would have associated with wartime emergency spending, not with peacetime normality. In many European countries, social commitments and bank backstops have been layered on top of already heavy public obligations, relying on ultra-low interest rates to keep everything affordable. Corporations have taken advantage of cheap money to buy back shares, fund acquisitions, and roll over older loans. Households in developed countries have used credit for housing, cars, education, and consumption. All of this created an illusion of stability as long as interest rates stayed near zero and growth looked solid. But debt is not just about how much you owe, it is about your capacity to service it when conditions change. Here is where history becomes useful. Over the past 4 centuries, there have been multiple periods where states and societies pushed their balance sheets too far. The Spanish Habsburgs in the 16th and 17th centuries, the Dutch Republic in the 17th century, the British Empire in the 19th and early 20th centuries, and more recently a series of emerging market crises and the global turmoil around 2008. Each time, the story looked a little different on the surface. Different currencies, different institutions, different technologies, but the underlying pattern had familiar elements: rising leverage, political promises that outpaced tax capacity, central authorities trying to hold a complex system together, and eventually, some form of reset that changed who bore the cost. Consider Spain again, not as a medieval curiosity, but as an early example of what happens when a state leans too hard on future promises. After the conquest of the Americas, flows of silver and gold allowed the Spanish crown to fight wars, build palaces, and maintain a vast imperial machine. On paper, Spain was incredibly wealthy. In practice, the crown was borrowing heavily from European bankers and merchants, pledging streams of future revenue to cover present expenses. As long as precious metals kept arriving and lenders believed the monarchy would eventually pay, the system limped forward. But repeated military campaigns, administrative corruption, and interest costs pushed the royal finances to breaking point. When Spain defaulted, more than once, the shock extended far beyond its own borders, shaking confidence in government IOUs and triggering broader financial stress. The lesson is not that modern economies will behave exactly like 16th century Spain. It is that a long period of comfortable borrowing can suddenly turn into a confidence crisis when creditors decide the math no longer works. A century later, the Dutch Republic built a more sophisticated and arguably more modern version of leverage. Amsterdam's merchants created instruments that look recognizably similar to today's equity markets and sovereign bonds. Dutch government debt became a trusted asset across Europe and beyond. For a while, this allowed the Dutch state to punch above its weight geopolitically and militarily, funding conflicts and colonial ventures through borrowing rather than just taxation. But by the late 17th century, repeated wars and generous interest terms led to a debt load that even a dynamic commercial economy struggled to sustain. At the same time, speculative episodes like Tulip Mania revealed how easy it was for capital to chase rapid gains in the short term while ignoring long-term risk. When pressure finally built up, confidence in key institutions and instruments eroded, and Amsterdam's position as the uncontested heart of global finance gave way to London. Once again, the mechanism was not magic. It was the compound effect of too many promises and too much reliance on the assumption that tomorrow would always be rich enough to pay for today. Fast forward to the British Empire and you see the pattern at a larger scale. Britain became the world's workshop and banker, and the pound sterling became the default currency for international trade and reserves. The British state issued bonds that investors across continents were happy to hold, confident in its industrial base and tax-raising capacity. That credibility allowed Britain to borrow heavily to fight major wars and to sustain a global presence. After the First World War, however, debt levels, economic strain, and a changed geopolitical landscape made it much harder to maintain the pound's pre-war parity and prestige. Attempts to return to an older monetary order without fully acknowledging the new reality led to painful adjustments, unemployment, and political conflict. After the Second World War, with even higher debt and a transformed global power balance, Britain had to accept a diminished role. The dollar stepped into the central slot, and post-imperial Britain had to manage its debts and obligations under very different conditions. Again, the point is not that the United States or Europe are just like Britain or just like Spain, but that when debt, politics, and global power get out of sync, the eventual rebalancing rarely feels smooth. Now bring the focus back to today's $315 trillion. One way to see this figure is as a symptom of a system that has been using credit as a pressure valve. When growth slowed, interest rates were cut. When markets trembled, liquidity was injected. When voters demanded more services, more security, or more bailouts, borrowing filled the gap rather than direct tax increases or hard choices. This pattern has been especially pronounced in the US and Europe, but it affects the whole world through integrated financial markets. Emerging economies, including the BRICS group and their partners, have also used debt to fuel development and to cushion shocks, sometimes in foreign currencies, that add another layer of vulnerability. The result is a planet where almost everyone owes someone, and where the margin of error is thinner than it looks. A small change in interest rates, growth assumptions, or investor confidence can ripple through the entire structure. So what does 400 years of history suggest happens next in situations like this? First, it suggests that systems stretched by debt usually do not get back to normal simply by hoping and waiting. Adjustments happen either through explicit restructuring, where debts are renegotiated, written down, or inflated away, or through implicit mechanisms like financial repression, where savers quietly bear the cost via returns that lag behind inflation. Second, it suggests that the pain of adjustment is rarely shared evenly. Those with flexibility, diversification, and good information tend to adapt earlier. Those whose wealth and prospects are tightly tied to local currency savings, fixed incomes, or highly leveraged assets tend to absorb more of the shock. Third, it shows that adjustment periods often coincide with political shifts, social tension, and institutional change, as voters and elites argue over who should pay, what should be protected, and which promises must give way. For the US and Europe specifically, the history of previous debt-heavy powers points toward a few realistic scenarios rather than one single prediction. One scenario is a long, grinding stretch of lower real growth and higher structural inflation than people were used to in the late 20th century, combined with periodic market scares and policy interventions. In that world, the system does not explode, but the average worker or saver feels steadily squeezed as costs rise faster than wages, and safe assets do not keep up with the true cost of living. Another scenario involves more visible flashpoints: sharp recessions, localized banking crises, sovereign stress in weaker members of a currency area, or moments when political conflict makes it hard to form stable governments and pass budgets. The actual path could combine elements of both: long stretches of apparent normality punctuated by sharp disturbances that reveal how interdependent and leveraged the system has become. So where does that leave you? As someone hearing $315 trillion in global debt and wondering what, if anything, you should do differently? The first step is simply to stop treating that number as a freakish outlier and to see it as a sign of where we are in a long cycle. High and rising debt loads are not inherently evil, but they are not cost-free, and history suggests they eventually force trade-offs. Understanding that can change how you interpret news. Instead of seeing each crisis as a random storm, you see it as part of a weather pattern. The second step is to recognize the limits of control. You cannot single-handedly fix global imbalances or rewrite fiscal policy, but you can choose not to build your own financial life on the assumption that existing trends will continue unchanged for decades. That might mean paying more attention to your own balance sheet, learning more about how different assets have behaved in past periods of stress, and thinking about diversification and resilience in broader terms than just which stock should I buy. This video is not financial advice, and it cannot tell you what to buy or sell. It can, however, give you a clearer mental model. When you hear about another rate decision from a central bank, another rescue for a failing institution, or another political fight over budgets and entitlements, you can place it on a timeline that stretches back through Spain, the Dutch Republic, the British Empire, and the post-war dollar system. You can ask, Is this what a stretched system looks like as it tries to keep everyone satisfied? Is this how promises are slowly renegotiated without calling it default? Is this how confidence erodes, not all at once, but in small, compounding doubts? In the next video, we will go deeper into specific historical episodes where debt loads were unsustainable and look at how different groups came out of those transitions, which strategies helped ordinary people preserve purchasing power, which assets held up better than others, and which assumptions proved most dangerous. If you want to understand what tends to happen before the headlines turn into full-blown crises, not just after, consider subscribing and turning on notifications so you don't miss that breakdown. And in the comments, share where you are watching from: the US, Canada, the UK, Germany, Australia, South Africa, or somewhere else, and whether you feel the weight of this debt-heavy system in your own life. History does not repeat perfectly, but the echoes are loud enough that ignoring them is also a choice.